percentage of sales approach will address this problem. This approach separates income statement and balance sheet. Let's look at the income statement first. For example, let's look at table 3.8 and 3.9. If the company supposed to increase 12.5% next year, their growth rate is 12.5% next year, then their sales is 1,250, which is 1,000 last year, and all the other items will increase except dividends and additions to retained earnings will all increase 12.5%. Now we have the new net income, $165. Now let's look at how to distribute dividends and additions to retained earnings. According to the table 3.8, they have a specific way to divide these two parts. And we can use $44 divided by $132. Then we got dividends payout ratio. Then we use $88 divided by $132. Then we got retention ratio. Now we have this percentage right now. We can use this percentage to calculate on next year's or planned future dividends and future addition to retained earnings. So we have altogether net income is $165. So the next year's dividends is $55 and next year's additions to retained earnings is $110. So this is the income statement. Then let's look at how do we calculate the balance sheet. Let's look at page 98, table 3.10. We can see that the assets part will all show as a percentage of sales. The percentage of sales 1,000. So if the company's sales increase 12.5%, and next year all these items will all increase 12.5%. So we have the total current assets next year is next year is total is 1,500, which is 300 more than the current year. And the total assets increased $750. But on the right side, the liabilities and owner's equity side, only the account payable related to sales. So only the account payable increased 12.5%. So it increased $75. And then let's look at the total number. The total assets increased 750 number and the $750. But the total current liability only increased $75. And the total owner's equity increased $110 because retained earning this year is $110. So the total increase of total liabilities and owner's equity is $185. So what is the difference between $750 and $185? That is the external financing we needed this year. So that is the difference between these two numbers, $565. Okay, so the next question is how we get this $565 so as to support our increase of 12.5% increase on our sales. We have three sources of the finance. The first one is note payable, that is the short-term liability, and we can use long-term debt, which is long-term liability, and we can also issue some new stocks or some other new equity to increase our owner's equity. These are three ways. So our next question is how to distribute these external financing. There's many ways to do this. because we have three methods. And for example, the example in the textbook is because we already have 300 increase on the current assets, so probably we can increase our current liability at the same amount of $300. Now we already increased $75 on the accounts payable. Probably we can increase $225. The rest amount, use 300 minus 75, so we got 225. We use it as notes payable, increase in notes payable, the short-term liability. And then the rest amount, probably we can use it like by to have some long-term debts, to have some long-term liability. So the rest amount is $565 minus $225, which is $340, which is the long-term debts, the increase of the long-term debts. This is just the one way. We have many ways to do this, and we have different we can balance our different interests and have the best option to get this finance. What if we cannot get this external finance? So probably we lost a 12.5% of increase. So this is basically the model, the financial model introduced on our textbook. Next, let's look at the external financing and growth, the relationship between external financing and growth. It is obviously to see that the more external financing we have, the more growth the company will have. So this is the basic relationship between the two. And also the need for new assets growth at a much faster rate than the addition to retained earnings. So the internal financing provided by the addition to retained earnings rapidly disappeared. Okay, in this part we will focus on two rates. The first is the internal growth rate. The second is the sustainable growth rate. What are these two rates? The internal growth rate is the maximum growth rate that can be achieved with no external financing of any kind. Well, we can understand it in this way. If we do not borrow money from other people, so that means we only use the money we saved last year, right? So what the money we received, retained earning. So the internal growth rate focus on how to use the retained earning. So we have the formula: internal return rate equals to return of assets times retention rate, which is retained earning divided by net income, and divided by 1 minus ROA times B, which is retention rate, which is the internal growth rate. And next, let's look at what is the sustainable growth rate. The sustainable growth rate is the maximum growth rate a firm can achieve with no external equity financing, while it maintains a constant debt-equity ratio. As we discussed in the part 4, the financial models, there are 3 ways to solve this financial financing problem. We can raise short-term debts, long-term debts, which is all the liability part. And the third one is to increase the equity. So this ratio, this rate, the sustainable growth rate, is focused on if there's no external equity financing, what is the growth rate the company is. And the formula is just simple, is the rate of equity times of the retention rate retention rate B divided by 1 minus ROE times B. So this two rate is used to evaluate the company's ability itself to solve the to growth in the future, rather than have any source of financing. And next, let's talk about the determinants of growth. On our textbook, the determinant of growth, ROE, return of equity, equals to, which we discussed in the dual-point identity, the third part, equals to profit margin, total assets turnover, and equity multiplier. So we generate and then we analyze the specific, these three factors. We look inside of this factor, and then we have these four important factors. The first is profit margin, and the second is dividend policy, because the more dividend we give to the stockholder, the less retained earning we left. So the less money we left for future development. The third one is financial policy, and the fourth one is total assets turnover. Right, the total assets turnover. Okay. So if sales are to grow at a rate higher than the sustainable growth rate, the firm must increase profit margin, increase total assets turnover, and increase financial leverage, increase earning retention, or sell new shares, so as to achieve this goal. Okay, this is chapter 3. Chapter 3 discussed how we use these financial informations and how we look at the inside of these factors to help us to make decisions. I hope you all understand all these ratios, all these formulas. Thanks for watching.